So I skipped over the portion of why the trade worked with the higher probability. And let me just change that. 5 points is for gold. NQ is 20 points, 1R. But we had the clear trend, so that's why I'm saying you can take the continuation model and enter there. But if we want to catch the reversal of the trend, we still want a clear trend, because there was so much selling off going here that barely any buyers were prominent enough to keep price on going lower. So when that normally happens, it's a lot easier to find retracements to these instead of trying to trade inside of consolidation periods. So step 1, clear trend to find a reversal or continue down. A 15-minute low or high swept. So we had this 9:30 opening candle actually swept London high, which I noticed when I went back in the video and saw the Bronx levels. Shout out BDM. So once we've taken that and we've not decided to go higher, again, there's your context for going lower. So we just need to find a trade that takes us to here. And now that this is done, where can we go? Higher or lower? So if we're going lower, this would be respected, this little gap, and we would come down. Like I said, we would trade down. We wouldn't be inversing it and trading up. Delivery of a 15-minute or higher time frame FVG. Now, the reason why price also was drawn here is if you go on the 15-minute, and I have this indicator which I'll link called Lux Algo Fair Value Gap. This just helps see gaps to save me having to like write it there to mark them out all the time. It's my way of like finding unmitigated bigger time frame gaps quicker. So if you actually pay attention, the delivery, like I say, is the change in state of delivery. We were delivering from sell side to get to buy side. And the reason why price was specifically drawn to this level is that not only did we have the previous session low, we also had this 15-minute unmitigated gap, which you can see the wick point right there. So again, this is where reading the market comes into play. We have all these other like gaps below, but these were all mitigated. They'd already been tapped into, so we don't need to trade lower. If we did, obviously we would clearly see bearish candles. But since we had so much strong upside and no sell opportunities, once we've sold off, for price to go anywhere, it needs liquidity to go the opposite direction. So we've taken out this swing low, which also then tapped into unmitigated gaps. So now this is no longer the strongest draw liquidity. This was strong because you have all these buy orders potentially in this general area. So as soon as price tapped into this, that's what's sending price upwards. And everything's manipulation. Institutions are manipulating orders to go to these levels. And session liquidity levels are most important because, to make the London highs and the London lows in the first place, you need a shit ton of sellers to stop price going higher, and you need a shit ton of buyers to stop price going lower. So once you've marked those out, like I said, they're your main draws of liquidity. And again, just going simply by the rules of the indicator. Fresh delivery, sweep of a prominent low or 15-minute low, clear trend to find a reversal or to continue with, going towards that liquidity, and 2 or more targets. So if this was our target from that continuation, like we saw on the 1 minute, we now have 2 strong reasons why we want to go lower, because we have the session low and the unmitigated. Apologies if this is getting a bit too cluttered, but I'll always be in the Discord to answer questions. But this is the gist of the model. Now, what makes an even higher percentage win rate is going to involve equal lows and equal highs. Now, these can happen on any time frame, but the strongest ones are going to be on the 30-second, 1 minute, and then 5 and 15. So I'll just quickly run over some gold trades that happened 2 days ago. Well, on Friday before market closed for the week.